Hello guys, welcome back to another video. Today what we're going to be talking about is kind of just like my thoughts on the overall market, how I think things are kind of going to roll out, and what I am positioning myself to kind of be prepared for all cases of what might happen over the next 12 or so months and what I'll be looking for. So getting into it, the first thing that I've kind of been keeping an eye on is President Donald Trump is talking about reinforcing tariffs on China. However, that's been kind of going back and forth with some tweets that he's been posting as he has a president with the Chinese president Xi, I believe. I might have mispronounced that. Don't cancel me over that. But they're set to have a meeting at some point to kind of discuss how to make a trade deal that's going to benefit both countries without having to negatively affect one too harshly. Kind of finding like the right balance, the Goldilocks zone is how I describe it. But this overall has like investors a little bit scared, which is why we've been seeing some pullbacks on some days, and then Trump would tweet something, then the market would go up. Some could argue this is some slight market manipulation. He's getting his buddies good prices and stuff by adjusting it, but can't really prove that too much. Another thing that I really like to look at, kind of, to understand what the sentiment in the market is, what other people are thinking, is the fear and greed index. The fear and greed index kind of, I'll attach a picture on the screen, has five different zones, right? It has extreme fear, kind of like a middle zone, greed, and extreme greed, right? General rule of thumb is that you want to be buying a little bit more when people are scared, because that's when the prices will be going down. And then you want to be a little bit more cautious when we're in greed or extreme greed, because that's when people are kind of in the honeymoon phase with their gains. I think it's going to be forever going on. The market's always going to be going up. There'll be no pullbacks or anything like that. So then when people get too greedy, you want to kind of be a little bit cautious. And when people are too scared, you could, deploy some money because that usually means we're in a correction or a dip of sort. However, we're currently sitting in an interesting gray space where we're really close to all-time highs, if not at all-time highs, while we're kind of in the fear zone. So it's a little bit interesting to decide what I want to be doing with my finances. Along with that, if we're looking at gold, gold year to date is up almost 60%, which is absolutely insane. I got into gold a couple years ago just because, I wanted a new asset class where I can put some of my money in that didn't quite track the markets the same way. It's been a great investment, but in general, when gold goes up, that means that there's like a lack of stability with the government currency kind of uncertainty. So people buy gold as like a kind of like a safety asset. It tends to move up when there's more uncertainty and stuff like that. A kind of inf counter inflationary. Yeah, and Bitcoin kind of plays a similar role in that. So we've been seeing, swings to all-time highs and slight pullbacks, but a lot of people buying, then it swings again. So those are two kind of assets that have been doing pretty well recently here. Taking all this into account, overall, if you're looking at the year-to-date performance of the indexes, the S&P 500, most stocks that are up in there, even like individually looking at them, we have a lot of momentum for the end of the year. Stocks have been rising outside of the tariff drop in April. We have a lot of positive momentum on the upside. You know, People are excited. We have Christmas coming up. Q4 is always usually a good time for the stock market because spending increases. Along with that, we have the Fed who's cutting rates. This should promote increased consumer spending, which will in turn drive business revenue up, which will in turn drive more growth in these companies. So it should realistically lead to better returns, right? But then we kind of having the clash of like the psychology versus the market, how it's looking. People are scared, yet the market's increasing, and we have fiscal easing like with the reduced interest rates. So ideally, this could kind of be more upside. But for me personally, what I believe it's kind of like a mix of things. So my overall strategy, what I'm doing currently with my finances, um, if I see really good value companies such as Amazon, Google, buying those up, because those are companies that, regardless of the economic state that we're in currently, I believe 5 to 10 years from now, they'll be in a lot better position. So I'm confident that they will have positive returns on that. There are some other companies that I think are also kind of interesting to look at. I'll just toss out some names. I've been kind of haven't pulled the trigger on any of these, just kind of like glancing at them, thinking about it, seeing if it's the best risk to reward for my capital. Because for me, since I don't have the craziest capital right now, I'm still pretty young. I want to make sure I'm using my money as smart as possible. But I've kind of been looking at UNH, might be those even lowers during the summer. Adobe, Duolingo, Salesforce. Those are some companies that have kind of been glancing around as um, some interest slowly, some retail interest slowly moving towards those. A lot of those kind of been getting battered this year due to fear of AI replacing them or maybe bad executive decisions in the company, right? So I'm not like gonna get scared out of the market. I'm not gonna get bullied out of it. I'm gonna keep buying dollar cost averaging over time, regardless. And again, if I have some extra capital, like recently this week, I've been buying up some Amazon shares. It dipped like to like 211. I was like, that's free money, so I've just been buying it up here and there. But on the flip side, I've also been trying to build up a cash position, um, because with this mix of mm, economic factors that should run the markets, but there's also fear. There's a lot of uncertainty what's going to happen. There's no guarantee. I don't think anyone can come out and say, yeah, within 12 months from now, the market's going to be up another 30%. You can't guarantee that. So I'm kind of building up a cash position just in case we have a pullback or a correction in 2026. Is most likely we probably will have one that's like 5 to 10%. I'll look to buy up a little bit more of that dip. And even if we were to go into a bear market, I think that's like 20% down from where we are right now. That cash position will again pay off. It doesn't hurt to have cash outside of my emergency fund, just because when there's buying opportunities in the market, I could take advantage of that, reduce my average cost, and then in the long term get even better outsized returns. Overall, my investing philosophy has always been to find quality businesses at discounted values due to um, sentiment. The consumer sentiment is really down on them when the company's growing. I love to do that with companies. I did that with AMD, Google, and I'm doing the same thing with Amazon right now. So that's kind of what I go for. And then one thing that I think people often overlook, it's not always about getting the craziest return, 300% or whatever. We've been having some smaller companies, CoreWeave, for example, has been running up. I don't even know the returns. They're up a lot. I'll attach a little picture on the screen here, but they had some crazy returns since their IPO. And that's great if you can get into those, but that's not consistent. My goal is to find, guaranteed sure businesses that are going to be around for the next 20 years that, are undervalued due to whatever it might be that I think will grow and keep their image and keep growing throughout long term. And I also want to preserve capital because the biggest thing when it comes to investing, it's great to have returns that are, really positive, but you also want to avoid losses because when you incur losses on your gains, you got to fight twice as hard back to make that up and go back on the positive side again. So yeah, I'm kind of doing a little bit of both. I'm still buying up, but I'm also building up my cash reserve just in case we have good future opportunities. As you know, there is definitely uncertainty in this market. But overall, my advice to everyone would be is to dollar cost average continuously into the market, whether we're lows, highs. Dollar cost averaging will average out your price, and in the long term, the market will go up, so you will be profitable. And that's what outperforms 95% of all fund managers in the world. So that's what everyone should do. But once again, I'm not a financial advisor by no means. I'm just a guy who has a personal interest in finances and stocks. These are just my thoughts. Give me your opinion down in the comments. I'd love to hear it and broaden my perspective a little bit. But I hope you guys enjoyed this video and take care. Have a great day. Bye bye.